So in this session, we're going to take my first look at a chart, but more than just looking at the chart, I'm going to talk about my particular swing trading plan and how that works and give you a little bit about how I look for certain reward to risk ratios. Now, this is actually an excerpt from an educational class I did for one of the largest brokers in Canada. So there is a section in the middle where there's some questions being asked, and it's from their traders. But I think it's a really good question, and I want to make sure that everyone sees and understands the answer I provide here. So with that, we'll get started. So I want to talk a little bit about my personal way that I look to enter trades. What is it I look for if I'm swing trading? This isn't necessarily long-term buy and hold. So I tend to look for, and what I was taught years ago is I look for a 3-to-1 reward to risk ratio. So what does that mean? What that means, and I'm just going to take this chart here of Merck as an example. I'm not saying this would have been a trade I would have entered, but I would have been watching it. And we'll get into the whys that I would have been watching it. But let's just say, for example, that as this thing is coming back and looking to potentially break this downtrend line, and we've got some volume here that's a little bigger volume on those up days, I may be looking to buy this stock and go long. Now, if I were going to do that, I want to make sure that I've got at least 3 units, whatever a unit is, to the upside versus the amount of risk I have. So if I were to enter this trade based on this prior support here, as a trader, I would be saying, you know what, if this thing went back down and it broke through this prior support, my premise is wrong, okay? At that point, I have to own it up and say, Steve, you're wrong. Take your stop, move on, okay? But if it does rally, if I am correct and this thing rallies up, it's probably going to rally up into this general area. That's where there's been prior battles, if you will. So I want to look to see, I've got 1 unit of risk, maybe that's 2 points, and then I've got 6 points of potential profit or gain before I were to exit my trade. This would meet my criteria of a 3-to-1 reward to risk ratio. Now, why is something like that important? It's important because if I choose whatever I want there as my rule for entry, I can then look at how many winners do I have to have? How many times do I have to be profitable at my target in order to have a winning trading strategy? If I'm getting 3 times the amount of value on my winners that I'm getting on my losers, if I win just a little more than 33% of my trades, I'm a winner. So I don't have to have a 70% win ratio in order to be a profitable trader if I put a rule set like this in place and follow my rules. So if I chose to look for only trades that offer a 4-to-1 reward to risk ratio, then I only need to win 25% of the time. But those are a little harder to come by. So the point being that as a trader, I need to plan my trade up front. I need to have a mental guideline that I'm going to adhere to. And I'm not going to get into a trade, a swing trade. Long-term investments are a different story. I'm not going to get into a swing trade that I'm looking to be in and out of in a week, a month, 2 months, whatever, unless it fits that predetermined criteria that is my trading plan. With that, I think the next slide here, we go to questions because it's really important that people understand that concept before we start looking at patterns. Any questions, Jeff? I'm guessing there will be.
Yeah, they're piling up. I think there's a lot of interest in your risk reward concept. One thing people are asking is just when you're planning those trades, are you always using the stop loss? Like you always defining that ahead of time or?
Yes. So every trader, if you don't take, in fact, I'll even pull this off here. So This is wristbands that were made up at one point that say, if you can read it, I plan my trade. It's probably shown backwards. And then on the other side, it says, I trade my plan. Okay? So it's very important that you don't just nilly-willy see something going up and you get FOMO, fear of missing out, and you jump in there too. Okay? That's the worst thing you can do. You have no plan for when am I wrong? You've got no plan for when am I right? When am I going to take my profits? So if you put a plan in place and you follow your plan, you don't judge yourself by how profitable you were or were not. You judge yourself by, did I follow my plan? And if your plan makes sense, if your plan has good reward to risk ratios associated with it, and you're giving yourself a big thumbs up, I followed my plan, the rest will fall into place. So we as traders can always say, gee, I should have held on longer. I shouldn't have sold that at 200 because it went to 250. You can't beat yourself up over that. You'll be doing it forever. So you just have to look at, did I follow my plan? And did that, if I'm following my plan consistently enough and I have a solid plan, I'm going to make money. In our next session, we're going to start looking at some of the most common chart patterns that you'll find out there, and some that I consider to be the most useful for me as a trader. And I think you're going to find it really interesting to see how many of these are formed and how they ultimately end up resolving themselves. So I'll look forward to seeing you in that next session.